What's up everyone, welcome back to another video with the Millennial Finance. Today, we'll be talking all things funding societies. What is it? What are the risks involved? How do we get started? Some of the pros and cons, and of course at the end of the video, I'll talk about my personal views on this platform and how I plan to use it. So make sure you stay until the end to find out. Cha-ching! Funding societies is not some new company with some new product, and it's actually been around for a while now. I started using this first back in 2018 when I just started my job, and I only found out about them because they came to my office to talk all things their product, and I was intrigued and I put in 1,000 ringgit just to test it out. But what is funding societies? They're actually a peer-to-peer lending platform, which to me is actually a pretty smart business model. Think of them as something like a platform that connects two parties who have interests that can fit each other, something similar to Grab and Shopee. On Shopee's site, they're just a platform. They have one side which is the merchant and one side which is the customers like us, and the merchant sells to the customers. Shopee is just sort of a platform that brings everything together. In Funding Society's case, on one side, there are SMEs who are in need of an injection of cash. Can be a multitude of reasons, but they need a loan and they're willing to pay interest for it. On the other hand, there are investors like us who want to put our money to work so that it can continue growing and compounding, and one day we can buy our Lamborghinis. Funding societies, like I said, is the middleman. In this case, they bring together both the SME and the investors to sort of become a platform for debt investing. Of course, they can't just do this because anyone can be a platform, but on top of all of this, they also do the necessary due diligence. They do collections and follow-ups on the SMEs so that we as investors have peace of mind when putting our money here. It's hardly a new business model. It's not something that's revolutionary and is first being heard of on the Millennial Finance. It's something that's available in many countries globally, and Funding Societies is one of the players in Malaysia. Even here though, there are a few different other platforms that provide the same service, but Funding Societies is the most established and has the largest market share in Malaysia. So what do investors get from this? Let's say there's an SME who needs a 100,000 ringgit loan. He needs this for 6 months and he'll pay it off monthly. As an investor, I'm willing to partially fund this 100,000 ringgit. So let's say I put 1,000 ringgit of this 100,000. Funding societies will pool money from all other investors until they hit their target. And as an investor, of course, since I'm in a way giving a loan, I will get an interest on my money, and that is the profit that I will make. I wouldn't classify this as a standard investment per se, something like our other investments that we talk about like stocks, ETFs, even Bitcoin and gold, because we're getting profits from contributing to these loans and getting interest from it rather than from ownership of an asset like, the S&P 500, Apple or Facebook. Anyway, that doesn't really matter. It's just a different sort of investment. I thought that was just cool to explain to you guys how it works. In a nutshell, an SME needs a loan, they're willing to pay interest for the loan as with all loans, and as investors, we're willing to put money to fund these SMEs. In return, they will give us our monthly payments together with profits. But what kind of loans can we invest in using the Funding Societies platform? There are 4 different types of loan that they categorize, being business term financing, accounts receivable financing, accounts payable financing, and finally, guaranteed investment notes. Business term financing you can think of as like a normal loan. A business needs a loan, they need to run their day-to-day operations. There's no specific use case for it, but they just need that money. Accounts receivable financing may be familiar to some of you accounting students. Basically, an SME sells a product to a customer. This customer has a 60-day payment term or whatever it is, and what the company wants or what this SME wants is for us to give this money to him first while he's waiting for his customer to pay him. Next, there's accounts payable. This is basically SMEs asking for an injection of cash so that he can buy things to run the company from day to day. An example of this is raw materials that a company needs to purchase to create their product. Finally, there is the guaranteed investment notes, which is still a loan, but it is guaranteed by a third party. You may think that with this, why would I invest in anything else? But as you guys go through the platform, you'll realize, of course, that when something is guaranteed, the returns will be lower. For this loan, it means that if the company somehow cannot pay you back, the guarantor will cover for it, which is why it's called a guaranteed investment note. Hold up, the Millennial Finance. Did you just say that a company may not pay me back? Well, yes. As with any other investment, there are risks involved when investing with funding societies. No one's gonna give you free money with no risk unless their name is Amanah Saham or EPF. Since we're funding the loans of these SMEs, if they fail to pay it back due to poor business performance or whatever other reason, we will lose whatever capital we have left with them. It can work in many ways. It is very uncommon for a company to sort of default an entire loan, but let's say you invest in a note that is for 12 months and they've paid you back for the first 6 months, but from month 7 onwards, they can't pay you anymore. So technically in that way, you will lose half of your principal. So far, this has only happened to me once, but I must give a disclaimer that I have very little investments in funding societies. Based on my experience, there will be scenarios where the company maybe isn't performing as they expected and they're having some cash flow issues and can't pay back their loans. In most cases, they just pay it back slightly late, or in some cases, they even restructure the entire loan, so maybe increasing tenure, but all this comes at a cost to them. So as an investor, whenever they do this, we will get more interest. This is all managed by funding societies. We of course don't have to go and chase or reach out to the SMEs. This is the value that they provide, being the middleman. In some cases though, the company may go into bankruptcy and the loan may go into default. In this scenario, we will lose our capital, and this is the risk associated with this kind of debt investing, as I was mentioning. So far, this has happened to me once. I didn't really lose my entire investment, but I did lose a portion of it once a company stopped paying. A good thing about funding societies is that they always keep us investors up to date. So whenever there is, let's say, missing payment or late payment, they will have updates on the app or the website itself, and we can always know what the course of action is and what the status of this payment is. So let's say you've heard all of this, you know the risks involved, but still you're interested in investing. How do you start it all? Of course, you would first need a funding societies account. If you want to sign up for funding societies, then use our code, which we will leave in the description below. It supports the channel, and you will also get 30 ringgit in rewards once you invest 1000 ringgit with funding societies. Next, you of course deposit your money, head over to the investment opportunities tab, and there you'll see all available loans that you can invest in. These usually don't last very long. People are very quick to snap up or sort of fund these loans, so it's not that I invest in something now and 3 months later you guys will invest, because most of the times it will just sort of close up. Based on my experience, since I restarted investing in funding societies, there are a lot of investment opportunities. They always come up with new ones, and if you have their app, they will even send you notifications whenever there are new ones coming up. If you want to do your due diligence before you invest, of course you can, because funding societies has this PDF or a fun fact sheet of every single SME who requests for a loan, and there you can get a lot of information about this company, and it's actually very comprehensive and sort of justifies their fees. To be honest, I usually don't really do this. My style is sort of just diversification. I'm not going to go through one by one, because I just split my money into smaller chunks into many different companies. So let's go into the pros and cons of debt investing with funding societies. First of all, the returns that we can get are potentially higher than what we can get from stocks. Of course, this is not applicable for 2020 and 2021. The stock market, particularly in the US, has been on a tear, and not many asset classes can actually compare. But if you look at the long-term average of roughly 7 to 8% from the S&P 500, then funding societies definitely has the potential to outperform that. Depending on the type of loan that you choose, it can go from 13-14% all the way up to 18%. But of course, don't invest just based on returns, because it could be a highest interest rate due to the company's poorer financial performance. Secondly, which is actually my favorite pro of debt investing with funding societies, is that it's a great diversifying tool for your portfolio. Even though I try my best to diversify my stock portfolio across many different industries, many different stocks and regions, in a way, they're still somehow slightly correlated. For example, the Malaysian stock market usually takes a cue from the previous day US stock market performance. So let's say if the US stock drops by 5%, usually the Malaysian market will follow suit. And then when we talk about things like Bitcoin, in March of last year, even Bitcoin dropped all the way to $3,000. So it's not really uncorrelated with the stock market. It sort of moves similarly as well. But yeah, thinking back about those days, imagine if I bought Bitcoin at $3,000. Of course, there are also other asset classes that can diversify your portfolio, like bonds and commodities, but debt investing is just a very interesting way to diversify your portfolio. I would never put all of my money into this, but having it as a portion of my entire investment portfolio, I think it's a good idea. The next thing I like is platform specific, is that Funding Societies does a lot of due diligence and has investors' money in mind every single time. Even though our money isn't guaranteed, like I said, Funding Societies does a lot in terms of churning out info, managing payments, and reaching out to the SMEs to ensure that every single loan that goes out has a high probability of being repaid. Finally, it is a great user experience. Using the web browser and the app is very simple to use. I know where everything is. It's not very traditional, it looks very digital, and that's something that I always like. They also have a lot of other cool features like auto invest, which I use, but I won't go into detail in this video. So now on to the cons. Debt investing has high fees. It's not specific to Funding Societies. I've taken a look at some of their competitors and it's roughly the same. I didn't talk much about fees in this video, but it can go up to 30% of your profits depending on the loan that you invested in. And this is much higher compared to other investments like ETFs or robo-advisors who charge a very minimal fee, but I don't think this is an apple-to-apple comparison. The amount of work that the team puts in here is a lot more, but still, that is not a justification on its own. Because of this high fee, as investors, we need to expect a certain level of outperformance to justify it. The next con that I have is that this investment style is very prone to black swan events. With something like what happened last year, it happened so quick, no one was prepared for it, and I think nearly 90%, or that was just a wild number off the top of my head, but many SMEs are impacted in the same way when we decide to lock down. Since this entire platform is for SME financing, it could lead to higher default rates when something like that happens. With equity investments, for example, last year, yes, it dropped 35%. A lot of people were impacted. A lot of people were sad looking at their stock portfolios, but it has recovered and it's gone even better and higher ever since then. In debt investing, on the other hand, if companies go bankrupt here, we will lose our principal, we will lose our money, and we can't hold on hoping for it to go back up because that is not how it works. However, Funding Societies is very proactive in managing this, and looking at their website, they have a very respectable 3.27% default rate as of the day that we're recording this video. The team has also told us that because of long-term lockdowns nationwide, they've taken steps like assessing impacts on their SMEs, implementing action plans, and overall tightening of their risk assessments. And this gives me good confidence that they're doing the right thing for us. However, we must know, like any other investments, we cannot avoid losses with this kind of investing. We just need to hope that our profits will outweigh our losses. So personally, I stopped using Funding Societies back in 2019. I used it for around 6 months, but I withdrew my money, and the reason for that is because back then I didn't have much money to invest and I wanted to use this money to invest in stocks instead. Now that my portfolio has grown a bit more, just very recently I put in 1,000 ringgit again to sort of retest this platform and see what it's all about again. And yeah, depending on how well it does, I might put more money here because, like I said, I want this as sort of a portfolio diversifier. When I put my money in, it was very quick. Within 2 weeks, all 1,000 ringgit was taken up. I spread it across 10 different investments, so 100 ringgit each. And yeah, let's see, within the next 2 or 3 months, I should be getting all of this money back and then reinvesting it. If you want to sign up for Funding Societies, use our promo code. We'll leave it in the description below. It really supports the channel and we appreciate it. So comment down below. Is debt investing something that will fit into your investment portfolio? Thanks for watching to the end, guys. Give it a big thumbs up and subscribe to the channel if you haven't already. See you guys in the next one. Peace out.